Welcome to the deep dive. The artificial intelligence infrastructure race just hit a major checkpoint, with three really different tech giants reporting their Q3 2025 results.
Yeah, we're talking AMD, the chip designer, Amazon, the cloud behemoth, and Palantir, that specialized AI software player.
Exactly. And these reports, they're more than just numbers, right? They kind of reveal these unique multi-billion-dollar blueprints for grabbing a piece of the AI pie.
That's the goal today. We want to dig into the earnings docs you shared, look past the headlines, and really synthesize what's going on. Strategy, valuation, competition, the whole picture for each one.
Okay, but before we get into the weeds with the numbers and comparing strategies, we absolutely have to do the groundwork, especially with financial stuff.
Right, absolutely critical. We need to be crystal clear here. We're just analyzing public data, financial results, analyst comments, all from the sources provided.
This is purely informational. A deep dive, nothing more.
Definitely not financial advice. You absolutely have to do your own thorough research before making any kind of investment decision. What we talk about today is just our analysis of the data.
Couldn't agree more. Okay, groundwork done. Let's kick things off with the hardware provider of the challenger, AMD. Advanced Micro Devices.
Right, AMD, they had an exceptional Q3 2025. It really signals their AI pivot is gaining serious traction.
What were the headline numbers?
Record revenue, $9.2 billion. That's up 36% year over year, and they beat their own guidance. And what I found pretty disciplined was their non-GAAP gross margin hitting 54%. Pretty solid.
Yeah, and it wasn't just the data center chips driving it, though. That was strong, too. I mean, data center grew, 22% year over year? A record $4.3 billion? EPYC CPUs, Instinct GPUs, that's the core AI push.
Definitely the core.
But the sources also show their client and gaming segments jumped a combined 73% year over year. Yeah, well, that's impressive resilience across the whole business, not just AI.
That holistic growth, it gives them a cushion, yeah. But let's be honest, the spotlight is squarely on AI. AMD's talking about tens of billions in annual revenue just from AI by 2027.
Tens of billions. That's a huge number to throw out there.
It's massive, and they seem confident. It's backed by the ramp-up of the Instinct MI350 series, which is happening now, and then the next-gen MI400 series coming in 2026.
And what about their strategy to defend that? Their moat, so to speak. It seems like they're locking in big deals, right? Multi-year partnerships with OpenAI, Oracle.
Yeah.
Getting that GPU capacity deployed.
Exactly. Plus their open software strategy with ROCm7, that's a direct shot at the competition. They're betting that their own tech, combined with making it hard for customers to switch away, gives them what the analysts call a wide economic moat.
Okay, but here's the rub, right? The valuation. Can they actually deliver on that huge 2027 promise, or has the market already baked it all in?
That's the tension. The valuation metrics are, well, they're up there. Trailing PE is over 127, forward PE is around 66.
So even though they beat earnings, some analysts are cautious. The stock price, like $258, is way above some fair value estimates around, $224?
Exactly. There's a concern that a lot of future growth might already be priced into that stock, and maintaining this push isn't cheap.
Right, the spending. Operating expenses shot up 42% year over year. That's mostly R&D for AI, for the MI400 pipeline. Strategic, yes, but it definitely squeezes profits in the short term. A key risk.
So if AMD is the, let's say, high-flying chip maker betting big, Amazon is the giant actually buying those chips, thousands of them, to build the AI infrastructure. Let's switch gears to their Q3 report.
Amazon, yeah, the scale is just different. Net sales hit $180.2 billion, up 13% year over year.
And operating income was $17.4 billion. But you pointed out, though, Speaker, that number would have been much higher, like $21.7 billion, if not for those big one-off charges. The FTC settlement, severance costs.
Well, yeah, $4.3 billion in charges. That's significant context. But the big story for the AI race is AWS, right? It reaccelerated.
It did. AWS revenue grew 20.2% year over year to $33 billion. That acceleration is key. Shows demand is strong.
So AWS is now on a $132 billion annualized run rate. It's just staggering. Confirms demand for basic cloud stuff and the new AI workloads.
And their moat, their advantage, it's partly just being the leader for so long, like 15 years straight in Gartner's Magic Quadrant, but it's also innovation.
Like their custom chips, Graviton, Trainium.
Exactly. Custom silicon helps them offer better price performance, making their cloud cheaper and faster. That reinforces the moat.
And they're using AI everywhere themselves, not just selling cloud capacity. Like in retail, that Rufus shopping assistant, they think that could drive over $10 billion in extra sales annually.
Yeah, they infuse AI across the board, retail, advertising, leveraging their existing scale. It's a different way to play AI compared to AMD.
Okay, massive revenue, AWS accelerating. But the elephant in the room is the cost, isn't it? That unbelievable CapEx number defines their risk right now.
Absolutely. Their trailing 12-month free cash flow is only $10.56 billion, which sounds like a lot until you compare it to.
The projected cash CapEx, $125 billion, just for 2025. And they expect it to increase in 2026.
Let's just pause on that. $125 billion. That's bigger than the entire market cap of many, many well-known companies. It shows Amazon is playing a fundamentally different long-term infrastructure game.
So they're spending like crazy to solve bottlenecks, like getting enough power, getting enough chips.
Precisely. They added over 3.8 gigawatts of power capacity in the last year alone, and they plan to double that again by 2027. It's about securing their lead for the long haul.
Okay, that spending explains why their PE ratio, around 34, is so much lower than AMD's. It reflects the slower growth bits of Amazon and just how much cash they're pouring into infrastructure.
Right. It's the infrastructure titan strategy now. Let's pivot again pretty sharply to Palantir, the specialized hyper-growth software company. This is where things get really explosive and really tense on the valuation front.
Palantir. Yeah, the CEO, Alex Karp, basically said it was maybe the best quarter any software company ever delivered. Big words.
He did. And the numbers were eye-popping. Overall revenue surged 63% year over year to $1.181 billion.
But the real story was the U.S. commercial segment, right? That just exploded.
Blew up, 121% year-over-year growth. They said it was insatiable demand for their AI platform, AIP.
And they're efficient, too. I saw something about the Rule of 40.
Oh, yeah. Record Rule of 40 score of 114%. Just to remind listeners, that rule suggests a healthy balance if your revenue growth rate plus your profit margin adds up to 40% or more.
So 114% is exceptional.
It's phenomenal. Backed by a 51% adjusted operating margin and actual GAAP profitability, $476 million net income. Fast growth and efficient.
Okay, what's their moat then? They call it narrow, but it's based on something kind of unique. Ontology. What even is that in simple terms?
Right, ontology. It's basically their secret sauce built over 2 decades. Think of it like this. They create a deep digital map of a client's entire operation, supply chains, finances, people, everything inside their software.
So it's not just generic software.
Not at all. It creates this unique knowledge layer specific to that client. Makes it incredibly hard for a competitor to just swoop in and replicate what Palantir does for them. And then they have these field deployment engineers, FDEs, who embed the platform right into the client's core processes.
Ah, so that creates huge switching costs. They're selling a whole operational model, not just software licensing.
Exactly. High switching costs are key to that narrow moat.
Okay, wait. If U.S. growth is 121% and they're hitting 114% on the Rule of 40, why wouldn't the stock deserve a huge premium? You said there was a sell-off after earnings.
Because the premium was already astronomical, and maybe still is. That's the extreme valuation tension. Investors are looking at the price today, even with those results, and asking if it's sustainable.
What are the PE numbers? I bet they're wild.
Get ready. Trailing 12-month PE, 397. Forward PE, about 255.
Wow, okay. 397 times earnings. That's pricing imperfection for years to come.
Pretty much. It's betting on flawless execution way out into the future. Our sources put a calculated fair value around $163, which is quite a bit below the current price of $184. So the market, while impressed, sees significant risk if they stumble even slightly.
And there are other risks too, right? Like they still need to spend money to hire AI talent, and growth outside the U.S. isn't as strong.
Correct. Operating expenses are increasing for talent and strategic investments, and international growth, particularly in Europe, was described as stagnant. It shows AIP adoption is really concentrated in the U.S. market for now.
Makes sense. So Palantir is the pure AI software growth story, but you pay a massive premium for it, and there's concentration risk.
That sums it up well. Intense scrutiny required there.
Okay, let's try and pull these 3 very different threads together. For you, the listener, trying to make sense of this AI investment landscape, the core difference really boils down to that growth versus value versus risk equation for each company.
Yeah, let's just line up those PE ratios again. Palantir, nearly 400 times earnings. AMD, around 127 times. Amazon, way down at 34 times. It paints a clear picture of the risk spectrum investors see.
So Palantir is priced for, like, perfect specialized software dominance. an all-in bet on their unique model.
Right. Amazon is the opposite end, valued more conservatively because it's huge, diversified, slower growing overall, but provides that essential infrastructure. It's almost like a utility play in the AI world, but a very expensive one to maintain.
And AMD sits in the middle, valued highly, betting on grabbing a big slice of the AI hardware market to justify that price. Needs strong execution.
And the growth profiles line up with that. Palantir's explosive 63% overall growth, driven by that 121% U.S. commercial, but on a much smaller revenue base, high margin, specialized.
AMD showing accelerating hardware growth 36% overall, targeting that massive AI revenue figure down the line.
And Amazon, the scale machine. Overall growth is slower at 13%, but AWS re-accelerating to over 20% on that massive $132 billion run rate. That AWS growth is the bedrock.
Okay, finally, the cash and investment piece. AMD actually generates strong free cash flow. Right. About $5.5 billion. Gives them flexibility.
It does. Palantir has a great margin on free cash flow of 46%, but the total amount is tiny compared to the others because they're much smaller overall.
And then there's Amazon. Spending that staggering $125 billion on CapEx, it crushes their free cash flow now.
But it's a deliberate strategy. They're spending now to build an unassailable long-term advantage in infrastructure, power, chips, securing their dominance for potentially decades. It's a massive long-term bet.
So if we summarize the models, AMD is the high-stakes hardware bet. Great momentum, but needs to keep spending on R&D. Amazon is the defensive infrastructure giant, using AI everywhere, but defined by that huge CapEx.
And Palantir is the specialized, high-margin, super fast-growing AI software pure play, but comes with that intense valuation pressure and concentration risk.
Three very different ways to invest in the AI future.
And what really jumps out, looking across all three reports, is that these giants all agree. AI is a massive generational opportunity. They have to invest heavily, despite the near-term costs and risks.
So the question for you, the listener, isn't just who grows fastest.
Exactly. It's more about which company's strategic cost, whether it's AMD's R&D spending, Amazon's massive CapEx, or Palantir's sky-high valuation premium represents a risk profile that you're comfortable with after doing your own thorough research, of course.
That really was a deep dive. Fascinating numbers, different strategies, different moats. We hope this helped you sort through the post-earnings noise and understand these three distinct paths in the AI race.
Yeah, hopefully it accelerated your understanding a bit.
Absolutely. Thank you so much for your engagement. If you found this discussion valuable, please do show your support for the deep dive. Subscribe, hit that bell icon. It really helps and means you won't miss our next essential analysis. Until next time.